Hello everyone, and welcome to this explainer. I'm really thrilled to have you joining us today. You know, whether you're a chartered accountant, a tax professional, a student, or a business owner, you're probably well aware that our taxation laws are undergoing a monumental shift right now. Today, we're zeroing in on one of the absolute most critical aspects of the new Income Tax Act 2025, and that is the completely overhauled framework for the collection and recovery of taxes. We're going to demystify Chapter 19D, specifically sections 411 through 422, and really break it down so it makes perfect sense. All right, let's dive right in.
So picture this scenario for a second. A taxpayer receives a demand notice for unpaid taxes, and they just decide to ignore it. Maybe they assume the administrative machinery is just too slow or way too complicated to catch up with them anytime soon. Now, under the old regime, maybe, just maybe, they had a little breathing room. But what happens if they try this under the new Income Tax Act 2025? Well, let me tell you, the consequences escalate much faster and with far more digital precision than we have ever seen before. Understanding this new reality is absolutely vital to keeping your practice and your clients fully compliant.
Here's a quick look at our agenda for today's session. We'll start with the introduction and legal provision, then breaking down the rules, move into a practical taxation example, cover compliance and documentation, address common practical issues, and finally wrap up with a summary and key takeaways.
Okay, let's get started with Section 1, Introduction and Legal Provision, looking at the shift to 2025.
The sheer scale of the structural simplification here is honestly massive. Think about the old 1961 Act. It had this hugely fragmented structure of 819 sections and 399 forms. The 2025 Act slashes the sections by 35%, down to 536, and the forms cut by over half, down to just 190. Now, the objective here isn't to fundamentally change the basis of the tax charge itself. Instead, it's about providing a streamlined, modern tax code with way less cross-referencing and much better digital integration.
Right in the middle of this streamlined new code, we find Chapter XIX D, which spans sections 411 to 422. This right here is the heart of our explainer today. The core objective of this specific chapter is to provide the statutory machinery, the actual legal teeth, for recovering unpaid taxes from defaulting assessees. It lays out exactly what happens when a tax that's been assessed and demanded just sits there unpaid, empowering the tax department to step in and enforce collection.
Moving right along to Section 2, breaking down the rules, where we'll compare the old versus the new mechanisms. Making this mental switch is crucial, especially if you're a practitioner or a student preparing for exams. You're probably intimately familiar with Sections 222 to 226 of the 1961 Act. Well, those have now been replaced by Sections 413 to 422 in the 2025 Act. Also, the old recovery rules from 1962, they are now consolidated primarily under Rule 225 of the new Income Tax Rules 2026. And here's a big one to remember. The classic Form 28 Notice of Demand is now Form 151. Seriously, anchoring these old concepts to their new numbers now is going to save you a ton of time in your daily practice.
Now, let's talk about the Tax Recovery Officer, or TRO, because Rule 225 of the new 2026 rules grants them some incredibly serious powers. If a taxpayer defaults, the TRO isn't just going to send polite reminder emails. They are fully empowered to realize that amount through direct, forceful action. We're talking attaching and selling movable or immovable property, and in extreme cases, they can literally order the arrest of the defaulter and their detention in prison, or appoint a receiver to take over management of the defaulter's properties. The enforcement machinery here is incredibly robust.
But wait, because it's not just the primary tax amount we're talking about here. Section 419 of the 2025 Act makes it crystal clear that the recovery net is cast very wide. Any sum imposed, whether that's by way of interest, a fine, a penalty, or literally any other sum payable under the Act, is recoverable in the exact same manner. So those powerful TRO tools we just talked about, they apply equally to unpaid penalties and interest too.
Let's shift gears to Section 3, a practical taxation example, to see this real-world execution in action. Let's walk through how this escalation actually plays out chronologically. Step 1, the TRO issues a notice of demand under Rule 225, Subrule 2, using that new Form 151 we mentioned. This form clearly directs the taxpayer to pay up within 15 days. Step 2, the default happens because the taxpayer misses this strict 15-day window. Step 3, the TRO wastes absolutely no time and escalates, immediately initiating the attachment of assets like bank accounts or real estate. And finally, Step 4, the recovery is finalized.
And keep in mind, they don't just recover the original arrears. They recover those arrears plus all the subsequent interest, costs, and even the charges of the recovery process itself.
Which brings us to Section 4, Compliance and Documentation, looking at what professionals absolutely must do.
This entire new framework is built to be a digital-first, highly structured system, totally moving away from those manual, text-heavy formats of the past. As a professional, you have to ensure digital traceability. For example, the new guidelines make it mandatory to have a document identification number or DIN on every single Form 153. You also need to urgently update your practice's tracking systems to flag these Form 151 notices. And most importantly, you have to proactively drill into your clients that this 15-day payment window is a hard, fast deadline. If they miss it, the automated consequences are severe.
Now here's a massive red flag for anyone trying to be overly clever with their assets. Section 499 of the 2025 Act comes with a very strict warning. If a taxpayer, either during pending proceedings or right before the TRO serves a notice, tries to transfer their assets or create a charge on them just to keep them out of the tax department's hands, the law says that transfer is legally void. Period. The tax department will simply nullify the transfer and attach the asset anyway. You absolutely must advise your clients that these evasive asset transfers are entirely ineffective.
Let's look at Section 5, Common Practical Issues, or what I call the transition trap. So, there's a really common and incredibly dangerous myth floating around out there. People think that when the old 1961 Act is officially repealed on April 1, 2026, all those old tax dues will just magically vanish. Let's make this perfectly clear right now. They absolutely do not. The official guidance explicitly states that any amount payable under the old law remains fully recoverable. What's more, the department is completely authorized to use the rapid, modern recovery machinery of the new 2025 Act to collect on those old arrears.
And what about enforcement actions that are already underway? Say a taxpayer's property was already attached under the 1961 Act. Does the department have to release it and start the whole process over? Absolutely not. Section 536, which is the Repeal and Savings Clause, guarantees continuity. Any existing recovery actions and attachment orders remain legally valid and totally enforceable, even after the new Act kicks in. This transition is built to be seamless for the department, leaving absolutely zero loopholes for defaulters.
All right, finally, Section 6, Summary and Key Takeaways to wrap things up.
Okay, let's do a rapid-fire recap. First, Sections 411 to 422 of the 2025 Act have completely modernized the tax collection framework. Second, remember Rule 225. It empowers the tax recovery officer with severe tools, including property attachment and even arrest. Third, don't fall for the transition trap. Old tax dues from the 1961 Act are going to be aggressively recovered under the new Act. Fourth, any existing attachment orders remain 100% valid. And finally, digital compliance using DINs and the new forms is mandatory. Which leaves us with a critical question to ponder. As the department shifts into this highly aggressive, digital-first recovery era, are your practice's compliance systems truly fast enough to handle that strict 15-day statutory turnaround?
I really hope this explainer has brought some much-needed clarity to Chapter 19-D for you and your clients. Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.